Welcome to IPX1031, and I'm Craig Brown. I would like to talk to you briefly about a partially tax-deferred exchange. That is where the taxpayer exchanger is closing on the sale of the relinquished property, subsequently closing on the acquisition of replacement property, a delayed exchange, just a typical normal 1031 exchange. But in this instance, the exchanger is not going to satisfy all the requirements to achieve a totally tax-deferred exchange. This is a concept of interjecting boot, something that's taxable, into the exchange. Typically, boot comes in the form of cash or debt relief. So let me give you a couple of real quick examples. Let's say we have a taxpayer selling a property for $100 that has a $40 mortgage. Now we're going to ignore the closing costs just to make the example a little bit more easy to understand. That means $60 of cash comes into the qualified intermediary, IPX1031, and $40 of debt is paid off at the closing of the relinquished property. Now let's say that the taxpayer decides that they want to purchase a $90 property. In the first example, we're going to fund $60 of exchange cash into the acquisition of replacement property. The exchanger is going to get a $30 mortgage, and at the end of the day, there's $10 of mortgage boot. $40 mortgage paid off on the sell side. Only $30 of that mortgage was offset on the buy side. Therefore, there's $10 of debt relief not offset. Exchanger has to pay taxes on $10. Another way to look at that exact same transaction is this time IPX1031 will only fund $50 of cash to the acquisition of the replacement property. The exchanger will obtain a $40 mortgage, and at the end of the day, there's $10 of cash that IPX1031 gives back to the taxpayer. That's $10 of cash boot. So we have two examples, $10 of mortgage boot, taxable, or $10 of cash boot, taxable. Tax liability on either is the same. That's a partially tax-deferred exchange, and I'm Craig Brown.